I'll try to look at the topic of the panel indeed from a regulator perspective, and I will try to complement what most likely will be mentioned by the Commission in panel 2 on sustainable corporate governance, with some more, if you want, traditional focus on investor engagement. In that sense, I will try to respond to your question, even though I will just try to sketch out very few ideas now, and maybe happy, of course, to get in more detail in the second round. So, from a regulatory standpoint, I believe it should be recognized that in recent years there has been an attempt to create a high-level, but I would say also rather comprehensive framework that facilitates long-term investor engagement. And of course, I'm making reference to the SRD review. That although it's formally, it was kicked off a few years ago, it has really actually been transposed across European member states just very recently, and was designed from the very beginning with an explicit intention to support long-term engagement. So you might recall that one of the assumptions at that time underpinning that revision was indeed to sort of foster the monitoring role of shareholders, believing that that role was often not sufficient, rationally apathic if you want, and that engagement could have been reinforced to reduce excessive focus on short-term returns. So there was also, I would say, at least at that time, but possibly I believe also now, that a sort of general recognition that private and collective engagement can affect corporate incentives via formal and informal tools, although the effectiveness of such engagement in producing long-term value creation is, of course, subject to debate. Also at that time, the discussion was also in terms of what are the engagement tools that can help, and so especially a few of them were raised in terms of dialogue with the board and top management, AGM voting, and shareholder proposals. But what the SRD2 does then is to actually try to cover a number of topics that directly or indirectly are related with shareholder engagement with issuers. And that it does that not only as the first edition of the SRD in terms of facilitating the exercise of shareholder rights, but also in a much broader manner in connection to the publication of engagement policy by asset managers and asset owners, in connection to the disclosure and the vote on director remunerations, as well as on the related party transactions, and in connection to disclosure requirements for proxy advisors, just to mention a few of the areas. So clearly, I mean, quite a framework and quite a wide set of areas that affect engagement. And for what ESMA did a year ago, December 19, it came out with this advice on short-termism from the Commission, if you want. That was a sort of other leg of Action 10 of the action plan, sustainability action plan of the Commission, and the other leg being, of course, this sustainable corporate governance initiative. And in this advice on short-termism, that was also complemented by two other advice, one from the EBA and one from EIOPA, ESMA formulated a number of suggestions and touched on another topic, and I'm happy, of course, to get in more detail. But one point that we emphasized when it comes to investor engagement was that, rather than sort of trying to sort of come with new things or new reinvent the wheel, if you wish, we thought that the SRD has not yet been tested in reality, and that those provisions could definitely be fine-tuned at the margin, but they should really be put in practice, and they should be tested to see whether they work in order to curb to some extent the short-termism. So, as this was the actual goal of the legislative initiative back in the day. So, while that does not mean clearly that minor adjustment to the SRD would be enough to address concerns on short-termism, the idea was, let's first look at the effectiveness of what we have. and this would be also in line with the better regulation sort of policy. But of course, if instead, we want also to speculate a bit going forward, it's clear that further policy tools can be also designed. However, here again, a word of caution from ESMA, if you wish, because maybe it's an area where more evidence and research would really help in better identifying if there are and what are the market and regulatory failures we are discussing. And the policy debate, we believe, would greatly benefit from that discussion, evidence-based discussion. For example, just to mention one area where ESMA's advice spent a few words on loyalty shares that now are really discussed a lot and they are not covered by the SRD. ESMA's advice indicated that an in-depth analysis of the effectiveness of some national regimes that now are in place would be really necessary before we engage in a new discussion at European level in deciding whether we need to cover that area at the EU level. And also, maybe just a last thought, and again, happy to pick up again later, sometimes also clearer definitions, as for example, certain concepts like short-termism, but also engagement to some extent, would help drive the discussion in a more, I think, stable and safe way, as there are sometimes some fluidity around the terminology here. So with that, I would conclude for this introductory remark, and I'm happy, of course, to discuss further later. Thank you.
Well, thank you, Valerio. That's extremely helpful. We note your note of caution, but nevertheless, you suggest some ideas. So that is a good start for the discussion. Maybe I can move to you, Amy, now, and thank you very much for joining us. And you are directly connected to what engagement means, and in particular, we would be interested from your experience to know more about kind of what could be done more in terms of stewardship, in particular in the context of the current pandemic crisis.
Thank you, and good afternoon, everybody. Yes, so I think as mentioned in the introduction, so EOS is a dedicated stewardship team, but we are part of an asset manager, Federated Hermes. But when we engage with companies, we're doing that on behalf of Federated Hermes, but also a block of other investors, many of them pension funds, all of them very focused on long-term issues and the drivers of long-term sustainable value. And we see engagement and stewardship more broadly as an integral part of responsible investment. We think more active ownership by investors is essential to build a global financial system that delivers not just long-term returns on investment, but also more sustainable outcomes for other stakeholders, which all ultimately is in the interests of beneficiaries. To do that, we believe very strongly that companies can only create and preserve long-term value if they provide goods and services that sustainably solve societal needs. And to do that, we think businesses need to be guided by a purpose that serves not only shareholders, and shareholders are of course important, but also their other stakeholders, society and the environment. And here, boards also have an important stewardship role as stewards of that purpose. In terms of engagement priorities and what's important, and I think particularly learning some lessons from the pandemic, I think one thing that COVID-19 has certainly done is emphasize the critical interdependence between business and other parts of society. So if we look at the very first phase of the pandemic, I think business's dependence on global supply chains became very, very clear, as did the importance of health and safety amongst employees and company responsibility for taking care of their workforces. And then as the crisis continued and continues now, we see companies at times facing perceived trade-offs between short-term performance perhaps and long-term treatment of those stakeholders. And we also see businesses needing to explain very clearly decisions they make, such as redundancies or changes to pay, particularly of low-paid workers, and justify that in the context of returns to investors, dividends, buybacks. after the crisis passes, we believe very strongly that companies will be remembered for the way that they have treated their various stakeholders and importantly, their employees and their customers. So in a way, the crisis has provided in a microcosm a great example of the importance of these long-term factors for sustainable value. And we think this interdependence and the need for a meaningful purpose to give boards the ability to navigate the short and the long term is only going to become more important because society faces many more bigger interconnected challenges, climate change being the obvious one, and related issues like biodiversity, but also addressing inequality and other issues. So the focus for stewardship, in our view, is going to be a lot to do with preparedness and resilience to known and unknown risks. Now, I think one known risk, which we think deserves a lot more attention than it's getting at the minute, is antimicrobial resistance. We've known this is coming for a long time. It's something we've been engaging with companies about for a number of years. And I think the health crisis we are going through at the moment has actually helped to galvanize some attention on that. And I think as a more general point has made us all much more sharply focused on preparedness for these known risks. And of course, then there are the unknown risks. And I think there we have to accept that is about generally building good financial and operational resilience. And I think the final point I'd make is in many cases as well, it's about getting the fundamentals right. Things like who sits on the board and what is the board looking at? You know, fundamentally, do you have people with the right skills and experience who have the right time and resources to fulfill their roles? Again, something that I think was put under quite a bit of pressure by COVID. And then there's issues like diversity, which is a really important topic, one that we've been engaging on for many years. And if I think about the UK, which is one of the markets where we engage with a lot of listed companies, as well as engaging on it throughout the year, we also reflect that in our voting policies. So for 2021, we'll be doing our most tough, I suppose, vote guidelines yet on gender diversity on the board, but also below the board, targeting companies that don't have enough women in their leadership teams. And we will also be voting on ethnic diversity for the first time, having talked about that for a number of years with companies and being supporters of the Parker Review recommendations. So we will consider in 2021 opposing chairs of companies that haven't met that minimum requirement and don't have a very credible plan in place to rapidly do so. So I hope that gives you a sense of the sorts of long-term issues that we're focused on in engagement, and of course happy to discuss these areas further in Q&A.
Well, thank you, Amy. That indeed gives us a very clear ideas and concrete examples of the kind of concerns and issues you and your investors are looking at. Maybe I can move now to Paul Coster. Paul, you notably represent the voice of individual shareholders who have different investment strategies. And one first thing that comes to people's mind is in terms of ESG criteria, do you think they understand it and they have the information to form judgment? Well, what is the viewpoint of your members?
Well, thank you. And I enjoy being here today. And after these very helpful introductions just now, I will try to focus exactly on this point. To what extent are we facing a major shift where we go from the traditional way of looking at business with returns and financial metrics? We are now moving into a qualitative area. And I think one of the problems that really comes up is that shareholders have, and not only retail shareholders, I think also the larger institutional investors have to familiarize themselves and learn the multi-focus in the communication that will be needed to help an investor to make investment decisions that meet their goals. So I think one of the real key aspects is we have to focus on how are we going to communicate these new targets, different angles how we look to the company. And one of the issues that I think complicates this whole effort is that there are no standards worldwide accepted in this field, which basically means that people can fill it right now with their own data and hope that that is clear when investors read it. There are, of course, examples where we seem to be building on new standards, but we are far, far away from having standards similar to the accounting standards. And I always comment, accounting standards have been around for 80, 90 years, and we're still fighting over them between the different regions. So we are facing a real challenge on that front. I think there will be another aspect that comes in play. Artificial intelligence. The data will be better for the analytical tools that this will be providing, but it really warrants special attention because we need to know how these algorithms are built up and what type of information it delivers. And I think investors in today's world, where there is a confluence of new dimensions with E and S, and as was just pointed out by Anne, the perceived trade-offs sometimes between the E factor and the S factor. Let's face it, a lot of companies are now focused on this whole climate issue. They are willing to direct huge amounts of investments towards building new electrical vehicles. 70 billion for Volkswagen, $27 billion for General Motors. But the payoffs will be far, far away in the future. How are we going to look at that when we know that this shift will have consequences for the social element and aspect of the business? And it was just mentioned, I think, pretty clearly, you need to be able, as a board, to communicate to shareholders in a way that they understand what the long-term consequences are of the different aspects that come up. I think there is a huge risk, which I really hope we can address, of misleading investors at this stage, where the wording sounds wonderful, but where the real content of the action taken by the companies is probably thinner than what appears when you listen to, or when you're reading the words. So in short, I think we're facing a new situation for the information, how we communicate with shareholders, and we need to get more focus on the narratives, which will bring different aspects to the board. They should pay a lot of attention how the narrative is being used. And I think we cannot escape in the communication with shareholders, given these new major shifts, these systemic shifts, with regards to scenarios. What does it mean when we follow scenario one? We are not sure what will be actually happening, but we have looked at 3 scenarios, and these are the scenarios that we are actively working on in order to have the best outcome for all stakeholders. Thank you.
Thank you, Paul. So we are still in a learning curve and a lot to come and to help investors to take appropriate decisions.
Absolutely, absolutely.
Can I move now to a more institutional investor and ask you, Hendrik, what is your perspective here?
Thank you very much, Fabrice. And I don't want to repeat all the dear colleagues have mentioned already. I think there's quite a lot of common ground, so we don't have to explore that in detail. I would like to focus on probably 3 things here. First of all, what is the role of investors in 2020, 2021 going forward? I think it is quite clear that due to the ongoing regulation, the Sustainable Finance Plan, and so on and so forth, the role of the investors is seen as the catalyst for indeed achieving this transformation of our economy. And I think that is a responsibility that no investor can shy away from anymore. And we will see also by the level of transparency the investors are now obliged to how well they do. And I mean, the PRI has already started their assessment in 2017, who are the signatories, but who are the ones that are happy to be signatory, but not doing anything. So I think there we will see much more where really the impact of these investors and the good things or the things they aim to do truly is. And I think that requires at some point also a more harmonized approach in a way that collective and collaborative actions are much more feasible, because at least from a German perspective, we are still having problems with regard to acting in concert issues, for example. And that brings us in a situation where the regulator has one expectation from us, being more responsible, as well as the clients are having that, but then at the end we are facing national regulations that basically block us, or that make it not as easy as it could be, or as it is in other jurisdictions, to really work on a major change. So that's probably one thing where we might have to understand that given the role that investors are attributed now with, they should also be equipped with the means to truly fulfill their mandate. So that's probably one. The second thing is, and Paul illustrated that very nicely here, that we are facing a major change with regard to the focus of the sustainability discussion. As climate change has been basically the hot topic for the past 4 or 5 years now, in 2020, S became imminent. And Amy also pointed out that we will have to challenge not only with regard to the pay structure or with regard to diversity in a more holistic sense, what is really the, let's say, also social license to operate for companies in the way how they treat their imminent stakeholders. So we also have to weigh that in, but I rest with our stipulation that G, governance, remains the key for these other 2 dimensions of sustainability, because without the qualified people on the boards, without the proper incentive structure, and without a truly shareholder friendly or an environment in which shareholder can also exercise their rights properly, we won't be able to succeed here. Last point I'd like to mention is one effect that we have not discussed yet, and that is the rise of passive investments. And that is exactly what also Paul mentioned earlier. There's a lot of investors writing interesting reports, making advertisements, etc., etc. But we should be aware that with passive investments, there is an obligation associated with, and that is, as you can't divest from this company that you hold in your portfolio, you are required to act as an active owner here. And that's, I think, something that needs to be balanced out in a way that passive investment structures may be a little bit more cost-friendly on the one hand, but they are associated with a clear stewardship function at the same time. Because in active investments, you can simply say, okay, I go away. That's not possible in passive investments. And I think that's probably the 3 topics that I think will be imminent in the nearest future. Thank you for allowing me that time.
Thank you, Hendrik. And before I give the floor to our last panelist, can I remind you that you have the possibility to put questions to the panelists through the chat. So I think we'll try to have a few minutes to answer those questions. Do not hesitate to do so. And then can I move you to you, Harald, for a complementary viewpoint on this?
Sure, thanks, Fabrice. And so as Hendrik said, we've already covered a lot of ground. So I also have 3 points to make. I'll try to make them as briefly and sort of concisely as I can, so that we can move on to the discussion. I think, first of all, I'd like to say something about short-termism and long-termism. So these are labels that are I think overused, and I think that's also evident from the conversation we're having today. I think they're in many ways are very unhelpful, because it's usually not very clear exactly what problems we're trying to solve by being more long-termist or being less short-termist. I think also the way the debate is framed, it sort of ignores the fact that in many cases the short term is actually incredibly important. And I think someone wise said the long term is nothing more than an adding up of a bunch of short terms. And I think there's a lot of truth in that. And I think also investors have a role to play in holding companies and boards to account, not only in the long term, also in the short term. So if we feel that there are things to be fixed in terms of short-termism or long-termism, let's try to be more clear about what exactly the problem is and how do we think we'll have a better world if we actually change the system. So that's one. Similar point on active ownership. So I also think we as a company think active ownership is incredibly important. I think in today's debate, there's a tendency to push active ownership basically into the ESG corner. And I think in many ways that's unhelpful. We think active ownership is most effective if it's undertaken by the portfolio managers, by the analysts who are responsible for the investment. In our company, we're basically a collection of active managers who are, for the most part, already very actively engaged with the companies they invest in. And I think sometimes there's a tendency for the whole engagement or active ownership agenda to be hijacked effectively by the ESG community. And obviously ESG is incredibly important, but it doesn't always have to be front and center. And so I think that's also, I think, a shift perhaps back to a more sort of reasonable discussion about what do we really mean by active ownership and who should be undertaking it. So that's the second point. The third point is around the role of governments versus the role of the private sector, because there also, I think there's often people are very quick to assume that the private sector can in fact play decisive roles in solving key societal challenges, whereas in fact, often we have to realize that governments are probably better positioned, at least to develop the frameworks and sort of set the general guidelines, and then for obviously the private sector to contribute to all of this. But I think often today the assumption that it's rather the other way around, that governments are probably going to take action, so let's all step up as the private sector. I think it comes with a lot of sort of unintended consequences, and I think it's something that also requires much more sort of reasonable and rational analysis of the problems we're really trying to solve. So I'll stop there, and then hopefully we can have good discussion about this.
Okay, thank you very much. I hope some questions are coming into the chat. Maybe before I collect all them, I have a question to both of you as expressing the views of the institutional investors and maybe in understanding more who are your clients. Because I guess this question of short-term or long-term, of course the investor wants short-term revenues, but he also agrees to create long-term value. But I guess the strategy depends very much on the horizon of their savings. And my question is really, do we have enough long-term capital in Europe to have a long-term investment strategy that fits the purpose of the ESG? There are pension funds in the Netherlands, but that's not the case across Europe. Or the behavior of the investors are rather short-term, low risk and liquid, which does not coincide with long-term objectives. So isn't it also an issue that structurally the savings and the investment do not match currently, which doesn't help creation of a capital market union, by the way, which I've been working to. So what is the nature of your clients' horizon, and do they have the savings that help reaching that long-term objectives? All right.
Shall I jump in first? Okay. Yeah, I mean, I think it's an interesting question because, first of all, we're a very large asset management firm. We have over 20 investment affiliates in our group, so with a total of over $1 trillion in assets under management. And so we have clients across the entire spectrum. So both geographically, but also in terms of institutional versus retail, pension funds, insurance companies, sovereign wealth funds, et cetera, et cetera. So I think also in terms of investment horizons, you see great diversity. Yeah, at the same time, I don't necessarily understand the problem we're trying to fix. And as I said in my comments earlier, I'm not sure there's really an issue here. I don't think there's a lack of capital, whether with a shorter term or longer term investment horizon, to invest in companies. And so I guess the underlying question is, is there a problem that we're not solving today because of the way that we're investing? And if we can identify those problems, let's try to have some form of diagnosis of, well, how do we fix that problem? And then can investors play a role? And then I think we can work back from there. But so I guess that would be my question back to you then.
May I add something? Because I really think this is a very interesting topic. In a way, I think one of our problems with the whole discussion, which was so eloquently put, that this is, drives us moves us in a corner of ESG. Without returns, there will be no future for any business. And I really have the feeling that the sentiment is so much against shareholders, this whole short-termism versus long-termism. Anytime I'm interviewed, people always say, well, obviously you're focused on the short-term gain. No, we would like to have a long-term investment in a company. I think without returns, none of the pension funds that you have highlighted, Fabrice, will be able to have its fiduciary duty fulfilled. So we need to balance the discussion in a different way. Right now, shareholders are being attacked, as far as we experience, for the wrong reasons. And obviously there are players that could improve their attitude, but there are a lot of investors that have a very positive attitude towards long-term investments, but you need to have returns. And one of the problems with, I think, the ESG, and in particular with E, many of these potential investments have only returns that are way ahead in the years to come. So how do you value that? What is the benefit of making these investments when a lot of things are unsure? Sorry, thank you.
No, thank you. That's very helpful. Hendrik?
Yeah, our client base is as diverse as Harald outlined, so I won't be putting on that, but it's indeed not contradictory, in my opinion, to have a focus on a dividend that's paid on an annual basis, which you are expecting for a row of years, and that you expect this dividend to be based upon sustainable returns of the company, and not because you have made some sort of interesting financial structure, but then basically it will become clear that in 3 years' time you're paying out the dividend, not of the returns, but out of the substance of your company. So that's what we think is important to bear in mind here. There are, of course, investment projects that have a longer time horizon. But as we've also witnessed in the past 10 years, I think we've understood that regulation and legislation might also change from one day to another very drastically. And we've seen that with nuclear power. We've seen that also with regard to the automobile industry. We will see that probably in other sectors going forward as well. At some point, you might end up not having a solid business model anymore. And this risk, this is something companies have to revisit on a constant basis. And as Paul also pointed out, these risks lie more or less currently in the ESG area, which of course have to be based upon operations that are still fulfilling an economic purpose as well. But I would absolutely agree, we are talking about short-termism versus long-termism and accusing shareholders for absolutely the wrong reason. Unfortunately, yes, there are some people or some investors that are not acting in the best interest in the long-term perspective, but you can't basically hold all of the other investors for that account. Sorry.
Agree.
Okay, thank you, Hendrik. Let's try to answer some of the questions that we are receiving here in the chat. And one of them, it's really now becoming very concrete, and to maybe illustrate all what we are talking about. there are a few questions about what would be, suppose an AGM happens tomorrow, the key issue for vote on which investors would like to express a viewpoint, or the three key matters that they should focus on. So let's imagine a concrete situation and what would be the investor request to vote on, and the three key priorities. Who could answer this? Maybe Amy.
Yeah, I can give a view on that. I mean, within the confines of the AGM, I think actually the topics become quite focused, because some of the issues you might talk about to accompany an engagement throughout the year, you know, the AGM isn't always the right channel for some of those topics. But I think thinking about an AGM held right now, I think the pandemic is the obvious important context for any business. What capital allocation decisions has the business been making in light of the pandemic? How has it treated its various stakeholder groups? Is the board in the right shape? So I think the main voting issues, I mean, pay is always an important voting issue. And again, we would now look at that through the lens of what's been done in the face of the pandemic, as well as how our pay structures aligned to delivering the right long-term value. We also look at, are there sort of perverse incentives there that we don't want to see that could drive the wrong sort of decision making? So I think pay would be a very important issue. I think board composition, do directors have enough time, the right skills? Have they fulfilled their duties in the right way during the pandemic? Are they on the right track with diversity? Because it's a great example of an issue that if you keep kicking it into the long grass, it never gets solved, and we don't want to lose traction on that. And I think that those would probably, through the lens of those issues, we would probably have those broader discussions.
Thank you, Amy. Very clear. There was a general question. Can I just pick another one from the chat, which is, as these virtual AGMs happening during the pandemic change something in the way shareholders participate more actively into companies they invest? Have you seen a difference? Maybe, Valerio, can I ask you that?
Yes.
Then we close.
Well, I'm not sure I have the answer for you, but I know that what we have learned is that in certain countries, so we have not a bit of a scattered picture across Europe, but in certain countries, the fact that we were forced to move heavily towards virtual AGM has indeed facilitated participation. And I'm not sure if that was reflected also in the, let's call it, AGM engagement, but definitely in terms of participation, which I think is an element we can sort of note. And I would say that probably 2020 will not be the last edition of AGMs in terms of seeing this effect. And maybe just coming back to your previous question, if you wish, on the engagement topics, I can also mention that you know, what Amy said is really in line with what we found in our 2019 advice, where we have surveyed the industry on that point. And indeed, the director remuneration, board appointment, and ESG related matters are the three key elements where institutional investors wish to engage at the AGM. Therefore, it's with Amy's picture.
Okay. Well, thank you very much to all of you.